Listen very carefully. As of this week, China is sitting on roughly $3.3 trillion in official foreign exchange reserves. And that is just the visible layer of the iceberg. When you add the shadow reserves sitting in state banks, the sovereign funds, the gold quietly accumulated to more than 2,300 tons, and the trade credits locked into Belt and Road, you are staring at an $8 trillion hydraulic system. It's not a savings account. It's a weapon. And if you line up the timestamps, the valves on that weapon all point to the same pressure point, the 2025 to 2027 window, with 2026 right at the center of the crosshairs. You were told this was about growth and development. You were told the dollar was too big to fail. That script is dead. Tonight, we're going to dissect what's really been built, a four-stage economic war plan designed to bleed the dollar, fracture Western markets, and flip the global system from dollar gravity into yuan gravity. The price on your screen is a lie. The atoms in the vaults are the truth. Imagine a giant dam. Behind it, trillions of pressurized water. In front of it, a town that thinks the river level is normal because the gauge has not moved yet. China's reserve system is that dam. The world dollar system is the town downstream. For 30 years, Beijing has been quietly thickening the concrete, extending the spillways, and cutting hidden channels around the valley. The markets only see the surface, a stable reserve number, a steady trade surplus, a responsible stakeholder. What they do not see is that the plumbing has already been rewired. The collapse does not start with an explosion. It starts with a quiet rerouting. Let's break the war plan into four stages. Stage 1. Absorb the blast. From the late 1990s through the global financial crisis, China swallowed dollars as fast as the West could print them. Trillions in treasuries, agency bonds, and dollar deposits. That looked like dependence. In reality, it was the first charge in a controlled demolition. Why? Because whoever holds the debris controls the cleanup. Owning that many dollar claims gives you leverage over the exit. It's like being handed the majority of the life jackets on the Titanic, while everyone still insists the ship is unsinkable. Stage 2. Convert claims into atoms. Once the pile of paper was big enough, Beijing slowly began exchanging paper promises for material truth. More gold, long-term commodity contracts, hard asset stakes in mines, ports, and energy infrastructure. Every dollar-based IOU that quietly got swapped into oil, copper, grain, or gold was a brick removed from the dollar's foundation and welded into China's. This is where our core rule kicks in: atoms versus paper. The herd hoards paper yield. The prepared investor hoards atoms. China has been behaving like the prepared investor for decades, while selling the paper is enough fairy tale back to Western pensions and ETFs. Stage 3. Split the rails. On the surface, the world still settles in dollars. Underneath, a parallel nervous system has grown. China's cross-border payment system, bilateral currency swaps, energy deals invoiced in yuan, and the digital yuan infrastructure are all fibers in the same new nerve. Think of SWIFT and the dollar system as copper wiring in an old building. Think of CIPS and digital yuan rails as fiber optic cable quietly installed in the walls while the tenants argue over the electricity bill. At first, traffic on the new line is tiny, a few percent of global payments. That's enough. Because this is not about replacing the dollar overnight. It's about giving key trade partners a fire escape the moment the main stairwell fills with smoke. So stage 4, you trigger the imbalance. Well, you do not need to nuke the dollar. You just need to create a situation where staying in dollars feels like staying in a collapsing building, while an alternative staircase is already lit and open. So how do you do that? Well, you wait for the perfect storm. The Western debt spirals. The fiscal discipline dies. The sanctions are used as weapons so often that every sovereign state asks, what if they aim it at us next? The share of reserves in dollars quietly grinds down year after year. And then you nudge. Now, not a public declaration, a quiet sequence of moves. China accelerates settling key trade flows in yuan. Strategic partners agree to hold more reserves in gold and local currencies. Some state-owned entities roll fewer maturing treasuries, redirecting flows into non-dollar assets. And a few accidental liquidity events in U.S. funding markets remind everyone how fragile the plumbing is. No single move is a smoking gun, but the combined effect is a hydraulic lock. The dollar's trying to rush out, an alternative rail's ready to catch the flow. So here's the physics of that moment. Picture the global system as two connected tanks. The tank A is dollar assets, treasuries, money market funds, bank deposits. The tank B is real stuff, atoms, energy, and non-dollar claims. For decades, the valves only allowed flow one way, into tank A. Your pension, your savings, your safe asset allocation. China's four-stage plan has been about quietly installing a new set of valves that reverse the flow when pressure spikes. When confidence breaks, when markets finally internalize that the dollar is not a risk-free asset, but a deeply political IOU, those valves flip. Money tries to leave tank A all at once. Counterparty risk explodes. The disconnect between screen prices and the real world goes vertical. That's not a mild correction. That's a phase change, like water turning to steam. Now let's step into the Western risk room on that day. It's a Tuesday, 4:12 a.m. in New York. Asian markets are open. Europe is yawning awake. The dashboards in the bank's risk centers light up. Dollar funding costs spike. Treasury auctions tail. Cross-currency basis swaps blow out. Gold and key commodities gap higher not by cents, but by whole percentage points before the bell. Someone finally says the quiet part out loud. The bid for dollars is conditional. The bid for atoms is infinite. Skeleton crews, junior staff running night shifts, slam into their limits and start calling bosses out of bed. Risk managers realize they're not just managing market risk anymore. They're managing career risk. Who wants to be the one holding a book stuffed with long-duration dollar paper if this is the day the market decides that paper is the new emerging market currency? Here's the nightmare. If those managers all run for the exit together, sell dollars, buy safer alternatives, they're sprinting straight into the arms of the system China has spent a decade building. Every rerouted payment, every invoice switched from dollars to yuan, every central bank that says, we'll add a bit more gold just in case. That is stage 4 doing its work. No announcements, no press conference, just flows. And flows do not lie. Now zoom out to the geopolitical board. The dollar is not just a currency, it's an operating system. Sanctions, trade routes, weapons sales, debt structures, all coded in that OS. When a critical mass of trade starts using a different OS, even at the margin, dollar power does not explode dramatically. It corrodes. The US can still print, it can still issue treasuries, but the rest of the world quietly stops trusting that those promises are neutral. They become conditional promises, promises that can be frozen, seized, or repriced at the stroke of a pen. In that world, who wants 100% exposure to the old operating system when a rival system, backed by atoms instead of deficit theater, is offering at least a partial hedge. This is the broken script. You were taught that de-dollarization would be a public revolution, a new currency announced, a summit, a flag. That's not how a forensic strategist does it. Real power does not shout. Real power rewires. China has spent decades restructuring its reserves, repositioning assets, and building trade systems that function like a four-stage kill chain. Stage 1. Absorb the dollars. Stage 2. Swap paper for atoms. Stage 3. Build alternative rails. Stage 4. Wait for the West to over-leverage itself and let gravity do the rest. So what does this mean for you, the prepared investor? It means you cannot afford to live inside the screen price illusion anymore. The spot price on your phone is a lie if it ignores counterparty risk. The index level on your brokerage app is a lie if it assumes the dollar is a constant. Mathematical inevitability is already baked into the structure. Too much debt, too little discipline, too many sanctions, and a rival bloc quietly wiring itself around the bottlenecks. You are not going to negotiate with this. You are going to position for it. Position how? By thinking like China has been thinking for 30 years, but on a personal scale. Less blind faith in paper promises, more ownership of atoms, less exposure to a single operating system, more optionality in real assets, real skills, real networks. While the herd debates whether the dollar can or cannot collapse, the prepared investor stops arguing with belief systems and starts mapping plumbing. Follow the flows, follow the atoms, and follow the incentives. You are early enough to adjust. Most of the world is not. Hold the line. Stay outside the paper trap. And never forget, in an economic war, the last people to understand what happened are the ones who trusted the screen.